Welcome to The Explainer. Today, we're going to break down one of the most famous and maybe one of the most misunderstood investment strategies out there, value investing. Okay, let's just jump right in with a really simple but super powerful question. What if you could buy $1 for 70 cents? It sounds kind of like a trick question, right? But this one idea, this is the absolute heart of the entire value investing philosophy. So, what are we really talking about here? Well, at its core, it's all about being a bargain hunter in the stock market. Seriously, think of it like that. You're on the lookout for really good companies that, for one reason or another, the rest of the market has kind of put on the discount rack. You believe the price tag is just wrong, and you're buying it for what you think it's actually worth.
Okay, so let's dig a little deeper into this. How do these bargain opportunities even happen in the first place? I mean, how can a giant company actually be worth more than its public stock price?
You see, value investors believe the market isn't always this perfectly rational machine. In fact, they kind of count on it being emotional. The market can totally freak out over some bad news, panic about one bad quarter of earnings, or just get swept up in general fear about the economy. And that emotional reaction, that's what creates a gap between the short-term price and the company's real long-term value.
And this right here perfectly illustrates the two main ways you can approach this. It's a philosophy made famous by legends like Warren Buffett and Charlie Munger. Path number one, you find an absolutely fantastic, top-tier business and you just patiently wait for its price to become reasonable. Or, path number two, you find a solid, a pretty good company when its price becomes an absolute steal.
All right, so that's the why. Now let's get into the how. What tools do investors actually use to hunt down these discounted companies? Well, they use a kind of financial checklist, almost like a detective looking for clues about a company's real health. They're screening for stuff that other people might be overlooking. Things like a low price-to-earnings ratio, which suggests you're not paying too much for its profits. Or a low price-to-book ratio, comparing the price to the company's net assets. They want to see a strong balance sheet, meaning it isn't drowning in debt. And of course, consistent profits. It all points to a sturdy, reliable business.
And here's a really crucial point. You're usually not looking for the next big tech revolution or some flashy stock that's all over the news. Nope. More often than not, value investing leads you to these established, predictable, and, let's be honest, sometimes downright boring companies that just keep on chugging along, making money year after year.
Now, this is not a magic formula. So let's get real and talk about the pros and the cons. Because like any strategy, it's got some powerful advantages, but it also comes with some pretty significant challenges. Probably the biggest advantage is this concept called the margin of safety. Because you're buying at a discount, you have this built-in cushion just in case you're a little off in your analysis or the company hits a rough patch. It also helps you avoid chasing hype and getting burned in speculative bubbles. And hey, historically, this strategy has a great long-term track record, often with the nice little bonus of dividends. But, and this is a big but, the challenges are very real. You have to be incredibly patient. There can be long periods, I'm talking years, where high-flying growth stocks just leave value stocks in the dust. You also face the huge risk of something called a value trap. We'll get to that in a sec. This is a slow and steady approach, and yeah, you absolutely have to do the homework. And that brings us to the number one risk for a value investor, the value trap. This is when you think you found an amazing bargain, but what you've actually bought is a broken company. It's not a dollar selling for 70 cents. It's a 50-cent piece that you just paid 70 cents for. The business has a real permanent problem, and that's why it's cheap, and it's probably just going to get cheaper. So to make this all even clearer, let's put value head-to-head with its famous rival, growth investing. Sometimes the easiest way to understand what something is to see what it's not. The difference is pretty stark when you see it laid out like this. Value investing is focused on what a company is worth right now and trying to buy it for less. Growth investing is all about betting on what a company could become in the future, and you're willing to pay a high price for that potential. One is generally about slower, steadier gains, while the other is about chasing faster gains, but with a lot more risk. Okay, so after all of that, we land on the final and honestly the most important question, is this strategy actually for you? This is all about mindset, so let's turn the lens around and see if this fits your personality. This is really a self-assessment. Does this sound like you? Are you really willing to wait, maybe for years, for an investment to pay off? Can you stay disciplined when it feels like everyone else is getting rich off the hot new thing?
Are you truly comfortable buying when everyone else is selling in a panic? If you're sitting there nodding your head, well, then this approach might be a very natural fit.
And so we come full circle. It really all comes back to that simple, powerful idea we started with. The strategy itself is beautiful in its simplicity. Find something great, buy it for less than it's worth, and then, well, then comes the hard part.
And that's really the final thought here. Success in value investing often has way less to do with complicated spreadsheets and way more to do with your temperament. The idea is simple, but actually doing it requires a level of patience that, frankly, most people just don't have. So the question isn't just whether you can find the bargain. The real question is, do you have the discipline to wait until the market finally realizes you were right?